In this video, I'm going to tell you what the PE ratio is and how to calculate it, its significance to investors, and why you want to take PE ratios with just a grain of salt. Hi, my name is Devrhoid Davis and welcome back to my YouTube channel. The price to earnings ratio, or PE ratio for short, is a term that investors will often come across when reading about stocks. It is a relative valuation metric that investors use to gauge whether a stock is overvalued, fairly valued, or undervalued. We'll talk a little bit more about this later on in the video. For now, let's look at how the PE ratio is calculated. The PE ratio is calculated by dividing a company's stock price by its earnings per share, or its EPS. The EPS can be found on the income statement of the company's audited financial statements. It's important to note that when calculating the PE ratio of a stock, we are supposed to use the audited financial statements, since that shows the complete or the total year of earnings for that company. It would be a mistake to use quarterly earnings in terms of calculating a PE ratio. The earnings per share, or EPS, can be found on the company's income statement in either its audited financial statements or its annual report, or 10K. If it is not there, and it often is, you can calculate a company's earnings per share by taking the total net income for the full year of operations and dividing it by the total number of outstanding shares that were in issue for that period. Now that might sound a bit complicated, so let's look at a few examples. I'm going to use two companies to demonstrate how it is we can find or calculate the earnings per share for a company and subsequently the PE ratio. Another thing to note is that there are two different types of PE ratios. One is called the trailing PE ratio and the other is called the forward PE ratio. It's important to note when dealing with PE ratios whether you are looking at the forward PE ratio or the trailing 12 months PE ratio. Alright, so here we have Apple Inc.'s 10K, or their annual report for the period ended September 28th, 2019. Remember I said earlier that when we use the annual report, what we're looking for is the earnings per share number, and that would be found in the income statement, which is going to be among the audited financial statements. So I'm going to scroll down through this document in order to try and locate the financial statements. From the contents, from the table of contents, we see where item 8 consists of the financial statements and supplementary data. So let's click on that. It takes us to page 31, and here we're seeing all of Apple's financial statements. So we have the consolidated statements of operations for the year ended September 28, 2019, along with the preceding 2 years. We also have the consolidated statement of comprehensive income for the same 3 years, as well as the consolidated balance sheets as at September 28, 2019 and September 29, 2018. Okay, so let's look at these two financial statements. Let's first look at the consolidated statement of operations for the year ended September 28, 2019. Here we can see that Apple actually reflected total sales of $260 billion. Now this is $260 billion because this number
is actually quoted in millions. And please take special note of this. The numbers are stated in millions except for the number of shares, which are reflected in thousands, and the per share amounts. So we're going to scroll down to find Apple's net income. So here we can see that the net income was $55,256,000,000. Notice also that we're given the earnings per share. So for Apple, we see that in 2019, the earnings per share was $11.97, and that was a basic earnings. Now the diluted earnings is what the earnings per share would be if we took into consideration convertible debt as well as options or any other form of shares that are not accounted for. Here they actually show us that the shares used in computing the earnings per share are as follows. So there were 4.617 billion shares that were used to calculate the earnings per share, and we can actually run that calculation to verify this number. So remember, the earnings per share is calculated by taking the net income. In this case it is $55,256,000,000, and we're dividing that through by the total amount of shares in issue, which is 4,617,834,000. And if we run that calculation here, you can see where we get back the exact number, 11.97 for the earnings per share. We can also verify this diluted earnings per share number, and we would do that by dividing the $55,256,000,000 of net income by the 4.648 billion shares that Apple had in issue at the end of that period. So let's put in those numbers, and we're dividing that number by 4,648,913,000. And here you can see that we've indeed get $11.89 per share. Let us calculate Apple's PE ratio. So what I'm going to do is I'm going to find Apple's latest share price, and I'm going to be dividing that by the earnings per share. In this case, we'll be calculating the trailing PE ratio. I'm going to take Apple's last stock price, last quoted stock price, and divide that by its earnings per share. To get Apple's stock price, we simply have to go to Google and type in the symbol AAPL. We see here that Apple's stock price closed at $313.14. Next, we're going to divide the stock price, 313.14, by its earnings per share, which was 11.97. And we see here that Apple is currently trading at a PE ratio of 26.16 times earnings. In the next part of the video, we will talk about what this number actually means. We're going to follow the same procedure. Firstly, by identifying MCB Financial Group's net income and then its earnings per share, and following that we will calculate its PE ratio, or rather its trailing PE ratio. Again, I'm using the company's annual report. And to find these documents, you can simply search Google for the company and then put annual report and the year that you are interested in. We can see here from the table of contents that the company's financial statements begin on page 123. Now this document is 346 pages long. By the way, this is the Honorable Michael Lee Chin. He is the chairman of the MCB Financial Group. So here we are at page 139 and we are seeing the consolidated income statement for the MCB Financial Group for the year ended September 30th, 2019. We're going to scroll down to find the net income as well as the earnings per share. From this line we can see that MCB Financial Group's net profit or their net income was 30,692,025,000. The earnings per share was recorded as $12.18, and that's an increase from $11.39 from 2018. We're also given a note here in note 16, and this note will actually tell us how they calculated the earnings per share. The earnings per stock unit is the same as the earnings per share, and as you can see here, MCB Financial Group recorded an EPS of $12.18 Jamaican for the 2019 financial year. Note 16 will actually give us more details as to how it is that they calculated this number. And I'm going to verify that. So I'm going to capture the net income or the net profit. So it was 30,692,025,000. Next, I'm going to scroll to note 16 in order to see the number of shares that were used in calculating the company's earnings per share. Okay, so here we are at note 16, calculation of the earnings per stock unit, and MCB actually provides a very detailed description of how they calculated their EPS. The note basically tells us that the basic earnings per stock unit was calculated by taking the net profit attributable to stockholders and then dividing that by the weighted average number of stocks in issue during that year, which is basically saying that they took the net income and divided it by the total number of shares in issue for the period under review. This note is also important. They're saying that the diluted earnings per stock unit equals the basic earnings per stock unit as there are no potential dilutive ordinary stock units. What they're basically saying is that they do not have any convertible debt or options available at this time. So those things would weigh on the total number of shares in issue. Here it is shown that their earnings per share were calculated using a value of 29,576,423,000 and a weighted average number of ordinary stock units of 2,429,180,000. Since we had captured the net income from the line above, I'm going to use that number and then I'm going to divide it through by the 2.4 billion shares that are in issue and to see if we get a similar number. So I'm going to be dividing that by 2,429,180,000. And the number we get is slightly higher for the earnings per share of $12.63. Now to calculate MCB Financial Group's PE ratio. So what we're going to do is we're going to take MCB Financial Group's current stock price and divide it through by the $12.63. To get MCB's latest stock price, we're going to have to go to the Jamaica Stock Exchange, and then we're just going to search for MCB. Here we can see that MCB last traded at $150, but the close price was $143.26. We will use the close price to calculate the PE ratio. So we're going to divide $143.26 by $12.63. That gives us a PE ratio of 11.34 times earnings. And again, we will talk about what this PE ratio is actually telling us in the next section. So again, to calculate MCB Financial Group's PE ratio, we took the last close price and divided it through by the earnings per share value that we calculated. We could have also just used the stated earnings per share. So if we were supposed to take the close price and divided it through by the stated earnings per share, we get a slightly higher PE ratio of 11.76.
The trailing PE ratio is a historic value. It is calculated using the company's earnings over the last 12 months, whereas the forward PE ratio is calculated using the company's estimate for the total current year's earning. The forward PE ratio can also be calculated using analyst expectations for earnings for the current year for a particular company. In other words, a forward PE ratio can be calculated using what analysts expect the company to earn in terms of net income for the current financial year. In the example that was just shown, we calculated the trailing PE ratio. To calculate the forward PE ratio, one would have to make an estimate of what the current financial year's earnings for Apple or MCB Financial Group would be, and then to divide the current share price by that number for the EPS. This is not as easy as it might sound, as there are a lot of factors that an analyst will need to consider when making estimates for current earnings for a particular company. These factors vary greatly and can be impacted by such things as taxes or tax breaks or tax penalties, expansion, acquisitions, litigation, and the list goes on. What's more, all of these factors could affect the company's earnings in either a positive or a negative way. An acquisition doesn't necessarily mean that a company will be in a better position going forward. And expansion doesn't always lead to a company reporting better earnings in the current financial year. I'd have to do a separate video taking you through the exercise of estimating a company's earnings. So if you guys would like to see that video, be sure to click the like button and subscribe to this YouTube channel. Analysts will often choose to report either a trailing or the forward PE ratio, but there are services out there that will actually report both. Now that we understand what the PE ratio is and how we can calculate it, let's talk about why the PE ratio is so important to investors. Remember earlier I said that the PE ratio is a relative valuation metric. Well, this is the first reason why it is so important to investors. It's a means of valuation. In other words, an investor will use a PE ratio to determine whether a stock is cheap, fairly priced or expensive compared to other stocks on the stock market or compared to the market as a whole. Generally, a low PE ratio is taken to mean that the stock is undervalued, and a high PE ratio is taken to mean that the stock is overvalued. However, there is no clear-cut number as it relates to the PE ratio that can be applied to all stocks. In fact, a stock with a significantly higher PE ratio might be a better bargain than one with a lower PE ratio. And we will explain this later on looking at two different examples. This is the first reason we say that investors should take the PE ratio with a grain of salt. A high PE ratio does not necessarily mean that a stock is overvalued, and a low PE ratio does not mean that a stock is actually at a bargain. The general suggestion of buying stocks with low PE ratios is somewhat incomplete in my opinion. It is more accurate to say that for two similarly sized companies operating within the same sector with similar operations, then the one with the lower PE ratio might be the better bargain. The one with the lower PE ratio is more attractively priced. I will explain this using an example. Let's say we have two companies, Company A and Company B, both with a market cap of $1 billion, so similarly sized. Let's also say that both companies are operating within the manufacturing sector, and both companies are basically growing at around 8% per year. The company with the lower PE ratio in this case will be the more attractively priced. Let's say Company A has a stock price of $10 per share and an EPS of 50 cents per share. Company's A PE ratio is 20 times earnings. Let's say Company B has a stock price of $30 per share and an EPS of $3 per share. Company's B PE ratio will be 10 times earnings. If both companies are growing at the same rate, we said earlier 8% per year, then Company B would be the better investment based on a PE ratio valuation method. Notice that Company B is still a better value for the investor despite it having the higher share price. In fact, Company A would be 2 times as expensive as Company B based on the PE ratio alone. As I said earlier, it is generally accepted that a low PE ratio is favorable and a high PE ratio is unfavorable. But this can be misleading. Let's look at an example. Let's say we had two other companies, Company X and Company Y. Both are in the technology sector. Company X has a market cap of $50 billion and is a manufacturer of computers and other handheld devices. Its stock sells for $100 per share, and it reported an EPS of $12 per share in their last annual report, down from $15 per share the year before. I'll also add that analysts expect that Company X will report an EPS of $9 per share for the current year. Company X therefore has a trailing PE ratio of 8.33 times earnings and a forward PE ratio of 11.1 times earnings. Got it? Great. Company Y has a market cap of $40 billion. It's a software company, and in the last 6 months has released an app that has gone viral. Its stock sells for the same $100 per share, and the company reported an EPS of $3 per share in their last 10K filing. Based on the number of downloads for the company's new app and the rate of growth in those downloads, analysts expect that the company will report an earnings per share of around $5 per share for the current financial year. Company Y, therefore, has a trailing PE ratio of 33.3 times earnings and a forward PE ratio of 20 times earnings. Notice that Company Y's PE ratio is far higher than that of Company X. So why is Company Y a better buy than Company X, even though its forward PE ratio is 2 times higher than Company X and its trailing PE ratio is almost 4 times higher than that of Company Y? The reason is actually more qualitative than it is quantitative. Company X is a larger company but has been experiencing a decline in its profitability. It is possible that new entrants have entered the market and are offering similar products as Company X but at a lower price, making it harder for them to compete. Furthermore, due to the nature of Company X's business, they would have to spend a lot more in order to generate more profit. The company would have to spend a lot more if they wanted to, say, expand into a new market or to acquire a larger market share. This could further erode Company X's profitability. On the other hand, Company Y's profitability is growing. It just launched a new viral app and advertisers will be more attracted to the company in order to show their ads to its growing number of users. Furthermore, Company Y would not have to spend as much if they wanted to, say, expand into a new market. Additionally, their marketing expense does not have to be as high since the viral nature of the app is attracting so many new persons to the platform. Company Y would therefore have to spend significantly less money in order to generate increased profits. Based on these factors, an investor who invests in Company Y is more likely to see an increase in the value of his portfolio than if he were to invest in Company X. Okay, so earlier I said that the PE ratio can be misleading. We've just shown that a company with a higher PE ratio can actually be a more attractive investment than one with a lower PE ratio. But what does the PE ratio really tell us? Fundamentally, the PE ratio is telling us how long it would take for a company to generate all of the money that we invest in it. This, of course, is assuming that nothing changes. And of course, I'm going to demonstrate this using an example. The PE ratio tells us how many years the company would take to earn back the money that we invest in it, provided nothing changes. As an example, let's say we pay $10 per share for a stock that is earning $2 per share in annual earnings. Let's assume nothing changes. By paying $10 per share, we're paying for about 5 years of earnings. Assuming all things being equal, at the end of year 1, the company would have earned $2 per share. At the end of year 2, its total earnings would have been $4 per share. $2 from year 1 and $2 from year 2. So in total, the company would have earned $4 per share. At the end of year 3, it would be $6 per share. Year 4, $8 per share. And then at the end of year 5, we'd have earned $10 per share. This would be equal to the $10 that we had paid initially for the stock. Thus, within 5 years, the company has earned back all the money that we, the investors, had invested in it. Said another way, by paying $10 per share, we paid for 5 years worth of earnings. As an example, let's say we paid $10 per share for a stock with full year earnings of $2 per share. In this case, the PE ratio would be 5 times earnings. Or said another way, by paying $10 per share, we are paying for 5 years worth of earnings. As investors, we ideally want the company to earn back our investment within the shortest possible time. And that is why companies with lower PE ratios have historically been seen as more attractive to investors. As we've seen from the previous section, this is not always the wisest decision. Over time, investors come to understand that earnings are not constant and stock prices are even more volatile than that. Over time, investors come to understand that earnings are rarely constant and stock prices are subject to wide, sometimes irrational swings. This leads me to the final points of this video. Why you want to take the PE ratio with a grain of salt. Investors ought to consider that the PE ratio is literally just a snapshot. Over any 12-month period, a stock's price can vary widely between a low and a high. The PE ratio, provided we're looking at the trailing PE ratio, could vary just as much. And in fact, any change in a company's price will also reflect a change in the PE ratio. Next, investors should consider whether they are dealing with a forward PE ratio or a trailing PE ratio, and also to look at how that value compares to other companies within the same sector and the market as a whole. Again, a company with a high PE ratio is not necessarily overvalued, and a company with a low PE ratio might very well be overvalued based on what's happening in that company and where it is potentially headed within the next 12 months. Lastly, I want to highlight that we do not calculate PE ratios for companies that report a loss, or rather companies that have a negative earnings per share value. Mathematically, it doesn't make sense to divide the price by a negative value, which is what the earnings per share would be, and logically, a company that is making a loss is not likely to provide any useful information in terms of the calculated PE ratio. Alright, we're at the end of this video. Feel free to share it with somebody who you think might benefit from this presentation. And if you have any thoughts, questions, or suggestions, feel free to leave them in the comments and I'll be sure to get back to you. Thanks for watching. Oh, and don't forget to subscribe to this channel for more educational content on investing, personal finance, and financial literacy. My name is Devrhoid Davis, wishing you all the best.